A technique known as dividend investing focuses on purchasing shares of companies that regularly distribute dividends to their owners. This strategy is preferred by long-term investors who want a steady stream of income and the possibility of portfolio development. Today, we will be explaining step-by-step process for creating wealth through dividend investing. Step 1. Understand dividends. It's crucial to comprehend what dividends are and how they operate prior to beginning to invest in equities that pay dividends. A dividend is a payment a corporation makes to its shareholders, usually in the form of cash or more stock. Businesses distribute dividends to their shareholders as a method to thank them for their financial support of the company and to draw in new investors. Regular dividend payments include those made monthly, quarterly, or annually. The dividend payment might differ from one firm to the next and depend on a number of variables, including the company's financial performance, market conditions, and macroeconomic trends. Step 2. Determine your investment goals. Choosing your investment goals is the next stage in building wealth through dividend investing. Do you want a consistent source of income, or do you want room for long-term growth? You can choose the categories of dividend-paying equities to invest in based on your investment objectives. Focus on equities with a high dividend yield if you're searching for a steady source of income. Dividend yield is calculated by dividing the annual dividend payment by the stock price. A high dividend yield can give you a reliable source of income, but it's crucial to remember that a high yield can also be a sign of a financially troubled company. If you're seeking for stocks with the potential for long-term development, you might want to concentrate on those that have a track record of gradually raising their dividend payouts. These stocks, also referred to as dividend growth stocks, can give you both income and the possibility of capital growth. Step 3. Research dividend-paying stocks. Once you have decided what you want to invest in, you should start looking into dividend-paying stocks. Start by focusing on businesses that have a track record of paying dividends and having a secure financial position. Seek out businesses with a history of steadily raising their dividend payouts, as this might be a sign of a financially sound organization. The company's industry and the state of the market should also be taken into account. While certain sectors like healthcare and technology may not pay any dividends at all, others, including utilities and consumer staples, are renowned for generating consistent dividends. Step 4. Diversify your portfolio. Diversification is one of the most crucial elements of effective dividend investing. Investing in a number of equities from various companies and sectors constitutes diversification. By doing this, you can lower your overall risk and safeguard your portfolio from market swings. Consider your investment objectives and risk tolerance while diversifying your portfolio. Focus on equities with a high dividend yield if you're searching for a steady source of income. Consider concentrating on dividend growth stocks if you're searching for long-term growth potential. Step 5. Monitor your portfolio. Finally, it's crucial to routinely check on your dividend portfolio. This entails monitoring the companies in which you have stock investments and their dividend payouts. Also, you want to keep abreast of economic and financial developments that can affect your portfolio. It could be time to think about selling that stock and investing the proceeds in a more dependable dividend-producing stock if a firm in which you have investments cuts or stops paying dividends. Step 6. Consider dividend reinvestment. Using the dividends you get to buy more shares of the same stock is a practice known as dividend reinvestment. As a result, your portfolio may grow over time, potentially increasing your dividend income. You can automatically reinvest your dividends thanks to the many companies that offer dividend reinvestment schemes. You may gain from compounding and lessen the effect of market volatility on your portfolio by reinvested dividends. But it's crucial to consider the tax implications and expenses associated with dividend reinvestment while making investment selections. Step 7. Be patient. A key component of creating money through dividend investing is patience. Dividend investing is a long-term strategy that calls for patience and discipline, as was previously discussed. Selling stocks or making rash moves in response to short-term market swings is one of the worst blunders investors can do. A well-diversified portfolio of dividend-paying equities over time can offer you a steady stream of income and the possibility of growth. Several businesses have a history of steadily raising their dividend payments year after year, which can help to give investors a regular flow of income. Step 8. Consider tax implications. Dividends frequently have a lower tax rate than other investment income types like capital gains. To learn how dividend income will be taxed in your particular circumstance, it's crucial to speak with a tax expert. If you invest in overseas companies, it's also crucial to take into account the effect of foreign taxes on your dividend income. Several nations deduct taxes on dividends given to overseas investors. You might be qualified for a foreign tax credit in these circumstances, which might assist reduce the amount of taxes you owe on your overseas dividends. Step 9. Avoid chasing high yields. It's vital to avoid pursuing high yields at the expense of other aspects, such as the company's financial stability and development prospects, even though a high dividend yield may sound alluring. A high yield may be a warning sign that a business is having trouble and may not be able to continue paying dividends in the long run. Focusing on total return, which includes both dividend income and capital appreciation, is another method to avoid pursuing high yields. You might gain from the long-term growth potential of top-notch organizations by concentrating on total return while simultaneously generating a steady flow of dividend income. Step 10. Rebalance your portfolio. Finally, it's critical to adjust your dividend portfolio on a regular basis. This entails modifying the distribution of your investments to make sure that they complement your risk tolerance and investing objectives. In the long run, rebalancing can help to minimize risk and optimize returns. Rebalancing can be carried out on a regular schedule, such as once a year or twice a year, or as necessary depending on changes in the performance of your portfolio. While rebalancing your portfolio, it's crucial to refrain from making impulsive trades or acting in response to momentary market movements. Rebalancing your portfolio is often advised once a year or more frequently depending on market conditions. Conclusion: dividend investing has the potential to be an effective long-term wealth-building strategy. These 10 steps will help you create a well-diversified portfolio of dividend-paying stocks that can offer you a steady stream of income and room for growth. Yet, it's crucial to keep in mind that dividend investing is a long-term plan that calls for persistence, self-control, and thorough investigation. The video for today has come to an end. What do you think about this? Tell us in the comment section below. For more updates in the future, don't forget to like and subscribe to our channel.